Hi everyone, I'm Marv Eisen from Timeless Dollar. And as a trader, I always look for the areas with the lowest possible risk to enter a trade. On Monday, March 8th, I see 7 such areas to trade on this chart of the S&P Emini, beginning at 9:30 where the market opened to 4 p.m. Eastern Time. This is a 3-minute candle chart with 4 points in between each horizontal line. There are 7 areas that I've earmarked where a trade could have been entered. The first area at 10 o'clock, coinciding with an oversold stochastic, was represented by the formation of a bullish harami. However, it wasn't a low-risk area to enter the trade, and for those who did, they would have quickly found themselves down 8 points with the following 3-minute candle. However, if they waited it out, they would have been rewarded. Nevertheless, it was not a low-risk area to enter the trade. Trade number 2 was to the downside, corresponding to an overbought stochastic, which happened to coincide with the previously established high of the day. And this would have been an area to place a trade at about 11:20. And that would have earned about a 12-point reward in a low-risk area opportunity. Again, an area where an opportunity presented itself was with an overbought stochastic at 12:30 if you were trading at 12:30, and because the high corresponded to the previously set high at 2 points. So this would have been an area to place a trade, but it would not have been an area of high reward, although it was an area of low risk. So that would have been an area to place the trade. Just a half an hour later at 1:20, if you were trading midday, the prices peaked at just about where they had been, the high had been established, and again, a low-risk opportunity presented itself over here and resulted in a very good profit to the downside. At 2 p.m., where that trade lost its momentum to the downside, if you had gone long, that would have been an area to trade as well. However, there's no indication that the risk was low other than stochastics being at a low point, at an oversold point. So it was not a good low-risk area to trade. The 6th area presented itself at 2:30, where prices were peaking in conjunction with an overbought stochastic. Again, it would not have presented itself a good low-risk area to trade, although the profit potential was there, but there's no way to really know, other than the overbought stochastic, that prices couldn't go even higher. However, at about 3:40, prices had peaked and stayed at a particular level corresponding with an overbought stochastic, but more importantly, if we drew a line through the 3 previously established points, this would have shown itself to be an area of resistance right here corresponding to an overbought stochastic, and we could have written that down to 1, 2, 3, 4, 5, 20 points right over here at a very low risk area to trade. That's how I call it on Monday, March 8th. And these are areas where I always seek the lowest risk to enter a trade. This is Marv Eisen. And if you're a conservative trader like me, check out my course at Timeless Dollar, Trading Mastery for Financial Freedom. I'm looking for only the most conservative areas to enter a trade so as not to lose money. And that's the rule number 1, don't lose money. Anyway, thanks for watching. I'll see you on my next video.